Okay, so today we want to attempt ICAN November 2024 question 3 Strategic Financial Management question. Just this recently concluded diet, and the question is fairly PLC. The question is displaying on your screen. You may just screenshot this your question, so as we're solving, you'll be able to follow through. Fairly PLC operates a low-cost and road transport business and is a listed company. By comparison to its major competitors, it is relatively small, but it has expanded significantly in recent years. The shares are held mainly by large financial institutions. The following are extracts from Fairly PLC budgeted statement of financial position as at 31st May 2023. Okay, we have our period here, May 2023, and then you have ordinary shares 100, reserves 50, and then bond 200. Dividends have grown in the past at 3% a year, resulting in expected dividend per share of 1 naira. So our current dividend is actually 1 naira per share, to be declared on 31st May 2023. Assume for simplicity that the dividend will also be paid on this date. All right, fine. Due to expansion, dividends are expected to grow at 4% a year from June. All right, so this is the future growth that has been given to us to the foreseeable future. The price per share is currently 10.4 ex-div, and this is not expected to change before 31st May 2023. The existing bonds are due to be redeemed at par on 31st May 2026. Now, look at our accounting period, 1st of June 2023. It means the bond actually has 3 more years to be redeemed. The market value of this bond as at 1st of June is expected to be 100.84 as interest per 100 nominal value. Interest is payable annually in arrears on 31st May and is liable for tax purposes. The tax rate for the foreseeable future is 30%. Assume that taxation is payable at the end of the year which the tax profits arise. Now, new finance. The company has now decided to purchase 3 additional vehicles at a cost of 10 million naira each, meaning they want to borrow a loan. So 10 million each multiplied by 3, that's like about 30 million for the 3 cars that will be purchased. And then they want to use loan to finance that. And the cost of this loan is 8%. All right, full new vehicle, which will be financed in full by an 8% bank loan on 1st of June 2023. All right, so this question is actually a basic question. And now the requirement is calculate the expected weighted average cost of capital as at 31st, so existing cost of capital. And then B, without further calculation, explain the impact of the new bank loan on Fairly PLC. You have cost of equity, cost of debt, and then you have the weighted average cost of capital. And then the C part says explain and distinguish between bonds and a bank loan. In so doing, explain why in the circumstances of Fairly PLC, the cost of debt may be different for the 2 types of security. All right, so let's quickly provide draft solution to this. Okay, so the A part says we should calculate the existing cost of capital. Okay. So for simplicity, our work equals to cost of equity multiplied by VE over VO plus cost of debt multiplied by VD over VO, then into 1 minus T. All right, where KE equals to the cost of equity, VE is value of equity. VD is value of debt. KD is cost of debt. And then VO is the value of organization, which comprises of the VE plus the VD. And then our T equals to the tax rate. Equals to the tax rate. All right, so now what we need to do here is to first get the component of this cost of capital. So we look at cost of equity, get value of equity. We go to cost of debt, get value of debt, and then we bring them together, and that solves this number one question. So we're going into the cost of equity. Okay, so cost of equity. Okay, so now from our previous video, cost of equity, you can use capital asset pricing model. You can also use the dividend valuation model, and sometimes you may have to use the M&M. All right, but in this question, what I can see is that their illustration or their question revolves around dividend. All right, if you look at this, you see dividend growth, dividend for the period, and all of that. So when you have information like this, what it means is that you're going to be using the dividend valuation model. All right, so here we are using dividend valuation model, DVM. All right, so according to the DVM, our KE equals to D0 into 1 plus G divided by market price per share X div, then plus G. All right, where D0 is our dividend now. And in this case, the dividend now given to us, I think, is 1 naira from the question. Dividend now given to us is 1 naira. And then you have our growth, G, equals to the growth rate. Now, I'm very sure that a lot of students may be tempted to pick 3. They gave us 3 growth in this question. You have growth from the past, 3%, and then you have growth to infinity, you have 4%. All right, so remember that when you're looking at DVM is simply telling us what will be the cost of equity if you are using dividend from now till infinity. It means the growth rate that is actually relevant to us here will be 4%, because they've given this growth rate of 3% has been used from the past, and that's what has given us this 1%. However, they say from that moment onward, 4% will be the new growth rate, and so the relevant growth rate here actually is 4%. All right, and then the MPS is already given to us as I think 10 point. The current MPS is 10.40. So you have 10.40. 10.40. All right, so what do we do next? We have all the parameters needed, and remember this 10.40 is X div. They gave us already that this is X div. So our KE equals to 1 naira into 1 plus G. Okay, so let me just put 4% divided by this already X div, 10.40. Okay, so we have our growth, and then 10.4, then plus growth, which is 4%. All right, so effectively, so this becomes KE equals to 1 times 1.04 divide 10.40, then plus 0.04, and that should effectively give me 10.40 plus 0.04, 0.14, and that should give me 14%. All right, I have my cost of equity as 14%. The next thing I need to look out for is the value of equity. All right, value of equity. Value of equity. To get value of equity, market value of equity is the market price per share multiplied by number of shares. All right, so from the question, they have 100 million 1 naira ordinary share. All right, so what that simply means is if I divide this 100 million by 1, the nominal value of their share is 1 naira. So I would have 100 million shares. So simply, market price per share already is 10.40 multiplied by 100 million shares. And so if I do this effectively, that should give me 1040 million. This is their market value of share. All right, so we are done with this equity part. The next thing we need to look out for is to get our cost of debt and also the value of debt. All right, so let's go into debt part now. Cost of debt. All right, so the debt that is given to us here, the debt component here, is redeemable debt. All right, and we know from our previous video that the cost of a redeemable debt, redeemable debt is the internal rate of return of that debt. Okay, so in this case, our I, which is referring to anyways, IRR. And how do you calculate IRR? IRR equals to the lower rate plus MPV of lower rate divided by MPV of lower rate plus MPV of higher rate into higher rate minus lower rate. Please take note that the original formula of IRR has a negative here. All right, but because your MPV of higher rate would always result in a negative value, and so when you're bringing this value in, you bring the absolute value without the negative, and so of course, and that will help us to provide solution to this. All right, so now let's look at the characteristics of this redeemable debt. Right, so very well, they gave us the coupon on the bond is the bond is 9%, right? Coupon is 9%. All right, and we have our redemption value because it's going to be redeemed at some point, and said it's going to be redeemed at par. So meaning redemption value is at par, which is 100. That is 100 naira. Okay. Time to redemption is 3 years. That's all. So first and foremost, let's get our relevant cash flow. The relevant cash flow associated with this bond will be the coupon that will be paid on this bond for the remaining 3 years. And of course, we need to net off the tax effect. All right. And from this question, they told us tax rate equals to 30%. So it simply means that our interest net of tax on the bond will be 9% multiplied by 1 minus the tax rate is 30%. So effectively, this should give me about 6.3%. 6.3%. So now let's quickly compute the IRR. All right, so computing IRR means that you get a lower rate, get MPV for the lower rate, get MPV for the higher rate, and also the higher rate, and then you interpolate to give you the rate. So in this case, we have year 0, year 1. I don't want to do the compound effect, so that for simplicity, there are actually shorter ways to do this. Year 0, the market value of this bond, I'm told that the bond is currently trading at 100.84. All right, so cash flow here, $100.84. This is my cash flow year 0, 84. Discount factor, I will just simply use 9%. To start with 9%, I'm going to be trying true extreme rate, 9%. Discount factor here is obviously going to be 1, and then my PV here will be 100.84. And then for year 1, my cash flow, 6% of 100. So my annual interest will be 6.3% times 100, and that should give me 6.3. All right, so in year 1, I will have 6.3. Year 2, I will have 6.3. And year 3, which is the redemption year, I would have both interest plus the redemption value. Redemption value is 100, and the interest is 6.3. So if I add the two together, it means I'll be having 106.3. All right, so in year 3, I'll be having 106.3. So my discount factor, 9%, year 1, 1.09 raised to power minus 1 is 0.917. All right, so if I do for year 2, is 0.842, and for year 3, 0.772. If I multiply this through, 0.3 times 0.917 is 5.778. That's 5.77, or let's say 5.78, just 2 decimal. And this 6.3 times 0.842 is 5.3. 5.30, 106.3 multiply 0.772 is 82.06. Okay, so my MPV here becomes 82.06 plus 5.30 plus 5.78. Okay, 82.06 plus 5.30 plus 5.78, then minus 100.84 should give me negative 7.7. So obviously this is going to be the MPV of higher rate, all right, because that's the one that's giving me negative value. So what I need to do next is simply to get the lower rate. So my lower rate, I'll just simply reduce the discount factor. So I'm trying discount factor at 5% now. If I'm doing 5%, here is still 1. So and my PV here will still be 100.84. Okay, so if I'm doing 5%, 1.05 raised to power minus 1 is 0.952, and year 2 is 0.907, and for year 3 0.864. So if I multiply this by 106.3, this will give me 91.8 0.907 times 6.3 5.71 times 0.3 that's 6.0. So if I add this together, 91.83 plus 0.71 plus 6 minus 100.84 is 2.7. So this becomes my MPV of lower rates. Okay, so I have all the details that I need. All I need to do now is my IRR, which is KD, and my lower rate is 5%, plus MPV of lower rate is 2.7 divided by 2.7 plus 7.7 multiplied by higher rate is 9%, lower rate is 5%. Okay, so if I do this effectively, this is 5% plus 2.7 divided by open bracket 2.7 plus 7.7, then multiply by 9 minus 5 is 4, then 1, right? 1.038. So 1.038%. So plus 5 is a 6.038%. This becomes my cost of debt. All right. So I have my cost of debt. The next I need to look out for now is my value of debt. Value of debt, which is the VD. All right. So we have the trading value, the nominal value of the debt from the question. Nominal value is they told us is 200, 9% 2026 bond, 200 million, and then we have the trading value. Trading value is already 100.84, and of course the par value is usually of bond is usually 100, and so my value of debt will be 100.84 divided by, for every 100, multiplied by the nominal value, which is the book value, million. And so effectively this should give me 84 divided by 100 multiplied by 200. This should give me 201.68 million. Okay, this is their current value of debt. All right, so now our VO will simply just be 201.68 plus value of equity is 1040, right? Yes, 1040 as computed. So if I add this plus 1040, so we have 1241.68. So if we want to get gearing of this company, their current gearing is 201.68 divided by 1241.68 times 100 over 1, based on market value, 201.68 divide 1241.68. That's around 16.24%. Okay, so the gearing is currently low. I think the B part of the question is actually talking about something like this. But let's quickly compute our work. We have all the parameters needed. So our work equals to the KE is 14%, as computed 14%, yes, 14%, multiplied by the value of equity is 1040 divided by total value, market value is 1241.68, plus cost of debt, which is the bond, is 6.038. So we can just approximate to 6.04. 6.04% multiplied by 201.68 market value of the debt divided by total capitalization of the company 1241.68. Remember that the cost of debt, this cost of debt is already adjusted for tax here, so there's no need to bring the 1 minus t into the work formula anymore. All right, and so our work becomes 1040 divided 1241.68 multiplied by 14 is 11.73% plus 201.68 divided by 1241.68, 0.16 multiplied by 6.04 is 0.98%. So if I add to 11.73, that should give me 12.71%. 71%. And this is our current cost of capital. All right. 12.71 is the current cost of capital. All right. So thank you for watching. So watch out for the next video for the B part of this question. All right, see you again in the next class. Please, if you have any question concerning what you have done, or you need a specific area you need me to clarify, please put it on the comment section and I'll be willing to provide clarity on those areas, if any. Thank you once again for supporting the channel.